substance, right? Like machinery, land and buildings, ships, motor vehicles, office equipment, that kind of thing. Right. What if you go to Coca-Cola Limited, right? Based in, let's see, where's Coca-Cola? Okay, in the United States, Atlanta, Georgia. Right. So let's say you contact them and you say, hey, I want the right, obviously you're going to have to pay for that. I want the right to be the only person in South Africa to be to be allowed to sell Coca-Cola, Fanta, and Sparletta, and all the whatever brands Coca-Cola has. I want to be the only. Obviously, you'll have to pay billions of US dollars, and they're not going to give you anything except a piece of paper, a right, saying that you can produce Coca-Cola. Right. Why would a person pay billions of dollars for just a piece of paper? Because that piece of paper has value. If you're the only one that can sell Coca-Cola, you're the only one who can sell that brand. It's an intangible value, right? So it doesn't have a physical, it's not machinery, it's not, but it does have value, right? So that's what we're kind of talking about when we're talking about intangible assets. Okay. So how do you get an intangible asset? Right? You can purchase it, like what we just talked about. You can purchase it. Um, you can also exchange it for an asset. You could give someone a vehicle and they can give an intangible asset. Acquired as part of a business combination, that's when you merge with another business, or you, the parent company, and um, you purchase a subsidiary. For example, you are Facebook, you purchase WhatsApp, or you purchase Instagram. Right? You, the holding company is Facebook, the subsidiary is WhatsApp or Instagram. Right? But it's not going to be examinable in 102 yet. You're going to be able to have a look at that next year in accounts 2, in consolidations and business combinations. Another way that you won't be required to be, you're required to know right now, is acquired by way of a government grant, and the other one is internally generated. Right, so we're going to have a look at these later on. Okay. So remember, when you are studying any standard, we said that there's going to be 4 broad categories. The first one is initial recognition or initial theory. Let's just say theory. The first one is theory. What do we mean by theory is this transaction that occurred, does it fall into the standard? Right, so that's your theory. The second part is initial recognition. If it does fall into the standard, how much are you going to record it at? Subsequent measurement is your third part. And that tells you, after years go by or time goes by, how do we continue to measure this asset or this item? And the fourth part will be, how do we show it in the financial statements, presentation, and disclosure? Right. So we're starting off obviously with the first part, and that is theory, which is extremely important, right? You must master your theory and be able to apply it to given questions. Okay. So recognition, what does recognition mean? When are we going to be able to debit intangible assets cost, right, in our statement of, in our general journal? Right? When are we going to be able to recognize an asset, debit an asset, and recognize it for the first time, and send it to bring it into our financial records? That's what we're talking about, recognition. When are we going to recognize it? So it's got to meet the definition of an intangible asset and the recognition criteria. Right, remember, just because something is defined as an asset, right, doesn't mean that we can recognize it. Right? It's got to meet both the definition, so it's got to be an intangible asset, and it's got to meet the recognition criteria that makes it an intangible asset to us that we can recognize. Okay, so let's go into the first part, and that is the definition of the intangible asset. So what's the definition of an intangible asset? It's an identifiable non-monetary asset without physical substance. Okay, now this definition needs to be broken up. Each word here or each phrase needs to be broken down. The first one is identifiable. Right? There's theory behind that. How are we going to prove that this intangible asset is identifiable? Number two, it's got to be non-monetary. So we're going to look at how do we prove that it's non-monetary. Thirdly, it's got to be an asset. Remember, before when we were babies, or when we were we used to just throw the word asset around loosely, but now we know that asset is defined by the conceptual framework. So we have to prove that it is an asset as per the conceptual framework. We also have to do this for PPE, right? So that is one, two, that's the third part of the definition. And the last part is without physical substance. So each word is actually a chapter of what we're going to be discussing. Okay, first part, identifiable. How do we know that this asset is identifiable? Can we basically what we want to do here is we want to make sure people don't just invent assets out of thin air. Right? It's got to be identified. We've got to be able to identify. We can't just have something in our head or something in the imagination that, hey, I'm starting off a company and I feel that my name, Mohammed, is very, people really respect my name, Mohammed, because I'm a lecturer here at UKZN. So everybody is going to be able to, is going to come to me and purchase, for example, if I'm selling drones. So I'm going to recognize my name, Mohammed, as 1 million Rand in my statement of financial position as an asset, brand name Mohammed. So I can just invent millions of things and I can just say that I have 1 billion Rand worth of assets when really I got nothing. Right. So that's why we're going to look at this definition to make sure that this intangible asset is valid. So the first one is identifiable. When is the asset identifiable? It's got to meet either one of these criteria. Right. It's got to be that the asset is separable. Right? So I can take this asset and separate it and give it to another company or sell it to another company. Right? Or it must arise from contractual or other legal rights. So it doesn't have to meet both. It's got to be or. Right. So let's look at the first one, separable. In order for something to be seen as separable, it's got to be capable of being separated or divided from actually it should say equity, or you can say entity, from the entity. It's got to be able to be separated from the entity. Okay, so if I've got a brand name, let's say I've got the only right or to make or to sell Nike branded shoes, right? And I can take that right and sell it to someone else. and my company can still exist. Right? So that can be separated. Right? Another one, sold, transferred, and remember this word is and, so it's got to be both. Sold, transferred, licensed, rented, or exchanged either individually or together with the related contract. So basically sold. Can I take this and give it to another company or sell it or license it to another company? If you can, then it's identified, then it's separable. And if it's separable, then it's identified. And regardless of whether the entity intends to do so or not. Why is this important? Because if you have, for example, a brand name, but you want to keep it, that means that you're not going to sell it, but it doesn't mean that it's not separable. It's just, this is just like a clause, like a proviso to make sure that we don't exclude an intangible asset just based on the intention of the entity. Right, so basically, can we transfer this intangible asset or this item from one entity to another? Okay, so that's separable. If it's separable, it's identifiable, and you've met this criteria. The first criteria of, now remember, it doesn't have to, if it's not separable, meaning it's not capable, it doesn't meet all of these criteria, these three criteria. Right? Basically, it doesn't mean that it's not identifiable, because there can be another way that it becomes identifiable. And that is that it arises from contractual or other legal rights. So if an item is not separable, identifiability can still be proved where contractual or other legal rights exist. These rights must be considered even if they are not transferable or separable from the entity or from other rights and obligations. So let's look contractual and other legal rights. Contractual rights are rights that an entity acquires as a result of entering into a contract. Other legal rights can arise by acquiring an item that gives entity certain rights. Right. So let's look at examples of this. So for example, let's say we go to the government and we apply to them that we want to be able to mine 10,000 hectares in Ladysmith. We think there's diamond there, so we want the right to bring massive machinery and development and all kinds of equipment, and we want the right to mine there. And we explain to them that, we're going to do this, we're going to worry about the environment in this way, and we're not going to damage it, and we're considering water, so we go through a whole process to apply. And they give us that legal right for 3 years. They say, okay, look, you obviously are a responsible company, and you've met all the criteria. So your company, let's give ourselves a name. We are UKZN miners. We are going to go and mine Ladysmith. And we have the government, they're giving us a 3-year license to go and mine in Ladysmith and go and find diamonds. Now they've given that to us. We can't take this and sell it to someone else. They have so can you see the difference? Right. So although it's not separable, it still arises from legal rights. So that would be identifiable. So that's what they're talking about, contractual and legal rights. Okay, you may not be able to transfer it to someone else, but it still arose from a legal right. Okay, let's look at some examples of some intangible assets. For example, what is a patent? It gives the holder an exclusive right to a process, design, a new invention for a certain amount of time. For example, a new drug is developed by Aspen. They register a 5-year patent, and no one but Aspen can reproduce that item or create a generic for 5 years. Right. So let's say Aspen goes and invents a pill, and this pill, you take it and you cure the next day from coronavirus. Right. They go and register this thing and they say that, and they get told that you guys, because you came up with this design, you patenting the process to make this pill, and nobody but you can produce it for 5 years. Right. After the patent has lapsed, then another pharmaceutical company can produce the same drug and market it. Right. So that this is known as a patent. Okay. Another example, a copyright. So these are all things that arise from the contracts. Copyright gives creators of original ideas, art, etc. Also, it could be um, uh, if you create some sort of media, right, the exclusive right to print, publish, perform, film, record, etc. for a given amount of time, and thereafter it becomes public domain. For example, Taylor Swift records a song and copyrights it. No other artist can use the same song words to another tune for or the chords for a number of years. Okay, so that's known as a copyright. Right. And the last example we're going to look at is a trademark. Recognize, I think most of us will be aware of these, a recognizable emblem, phrase, or other symbol that is unique, that uniquely identifies a specific product, service, or entity. Right. We don't even have to write your McDonald's that you know it's McDonald's. Right. So that's a trademark. I can't just go and mm, open up a McDonald's and say I'm selling McDonald's burgers. I need to pay the holder of the trademark to allow me to go and do this, right? So I think these are self-explanatory. The same with Nike. I can't just go and make T-shirts and put the Nike emblem on it. I've got to have the trademark. If I have the trademark, it's an intangible asset, or it's definitely identifiable. Okay, what about money spent on an advertising or marketing campaign? So um, I want to. I've got a brand. Right? My brand is um, uh, Muchino's Chicken. Right? So I have just started a new brand. It's called Muchino's Chicken, and I want to advertise Muchino's that we are the healthiest flame grilled chicken in South Africa. And I spent 500,000 rand marketing my brand. Right? That marketing campaign cannot be recognized, or because it's not identifiable. How do I know it's not identifiable? I can't separate that advertising cost and sell that advertising cost to another company. And that advertising cost, it didn't arise from contractual or legal rights. So one is the brand and one is advertising of the brand. So the advertising of the brand can't be recognized. So every time they ask you, is this thing an intangible asset, you have to look at the definition. Right? And when it gets kicked out from any one of these four items, then it's not an intangible asset. Okay. So we have discussed the first part of the definition, which is identifiable. It's got to be one of these two, separable, or arises from contractual or legal rights. And remember, separable has a separate breakdown. Right? Next part, non-monetary. It has to be non-monetary. But so to understand what is non-monetary, you got to know what is monetary. Right? Monetary is cash. That's the key word here. It's cash. Now, so if you've got cash in your bank, right, bank account, let's say, for example, you've got a net bank current account, 1 million rand. That's not an intangible asset because that is monetary. On your statement of financial position, Let's actually open that up. Can get a bit more context. Okay, so under my statement of financial position, I'm not going to write here intangible assets and write my bank account. That will just go under cash and cash equivalents. Okay. So it's not just your bank account, there's cash equivalent, meaning there are other things that are equivalent to cash. Other things that can be equivalent to cash, your current bank accounts, investment accounts like fixed deposits, money markets, and notice accounts. Right. So notice account, you get like a 32-day notice account where you have to tell the bank, for a 30-day notice account, we tell the bank, I'm intending to withdraw R1 million from this account. You have to give them 30 days before they put that into your account. Right? So basically, we're talking about bank accounts. So all of that is monetary, and that won't fall under intangible assets. It has to be non-monetary. Okay, got a question here. Flexi account? Yeah, any accounts, bank accounts are monetary. So those won't be intangible assets. You'll just put them under cash and cash equivalents, not intangible assets. Okay, so we've gone through identifiable, non-monetary. The third one is got to be an asset. Right? I don't actually need to go through this, right? We've gone through too many things, too many times. Asset, it's a present economic resource controlled by the entity as a result of past events. So you've got to prove this, that it's a present economic resource. And always the main thing is your control. Right? How do you prove control? You've got to be able to restrict access to other people using this asset or getting the benefits from it. And you've got to be able to get the benefits from it. Right? Risk and rewards, that's another key word. Right? So when you're trying to prove control, these are the criteria that you use. Okay. Also, it doesn't have to be future economics benefits don't have to always be only inflows. It can also be cost savings experienced by the entity as a result of the resource. For example, let's say you pay for an expense for next year, you pay for it this year. For example, you prepay your lights, water, electricity. Prepaid expense. What's a prepaid expense? It's an asset. Because next year, when you actually have that expense, you won't have to pay it. So it's a cost saving. Now, let's have a look at this example. A company gives training to permanent employees that is specific to the company and will help these employees to perform more efficiently and effectively. Can this be recognized as an intangible asset? The answer is no. Although the training is identifiable and non-monetary and does not have a physical substance, the asset definition is not met due to the inability to prove control. Can you control people? They can just resign and they can go and use the skills for your competitor. So because you can't, that's also a reason why you can't capitalize your staff. You can't just say, yes, Mr. Mr. Becky, Mr. Becky Dlamini is an excellent staff member. He is highly qualified and he has very good skills. And we want to recognize him. He's worth the 10 million. You can't control him. So that's not an asset. So asset definition, we're not going to go too deep into it. We've already gone to it. You've got to prove the asset definition, which is the third part of your intangible asset definition. And the last part is without physical substance. An intangible asset has no physical form, unlike property, plant, and equipment, which has a physical form. So physical form, your machinery, you can touch it, you can operate it, vehicle, you can drive it. This thing, no physical form. It's just a right. Okay. What happens if the item has both a tangible and an intangible aspect towards it? What do you do? Is it going to be PPE or is it going to be IAS 38 intangible? Will you identify which aspect is more significant, the tangible or the intangible? If the tangible is the significant part, then obviously PPE, IS 16. If the intangible is more significant, then obviously IS 38, intangible assets. So let's look at an example. One example, a fishing license. A fishing license, right? We can talk about two types of fishing license. One is your recreational use, where you go to the post office and they'll give you a license. You can go and take your fishing rod now and go and fish. But nobody's gonna, the parks board is not gonna hassle you, right? They're not gonna steal your fish. They'll say, where's your license? You've got your license? That's fine. You can now fish. The other one is maybe a commercial fishing license. They tell you that you are now allowed to take your trawler and go and troll a net and catch a lot of fish and sell it to seafood stores. Right? So that's a fishing license. Now, a fishing license has a physical form. What is that? It's the piece of paper that you get indicating that a particular person or company holds a license. Right? So that's your physical form. It's the piece of paper. It also has an intangible form, giving the person or the company the right to be allowed to fish based on the rules contained in the license. Okay, which one is more important, this paper or the actual right to go and fish? Well, ask yourself the question. You as the company, you're a fishing company. What do you want more? Do you want the right to go and fish? Or do you want the paper? Obviously, you want the right. If they told you, look, we're not going to give you a paper, but you are going to have the right to fish. You're obviously going to choose the right to fish. Right. So just the paper being physical, that you can hold the paper, that's insignificant. The right, the intangible part of it is more significant. In such a case, the intangible aspect is more significant, as what is of importance is the ability and right to be able to fish rather than the physical proof that a fishing license is present. Obviously, that's important. You're not going to go and throw your document away. You're going to file it, make copies of it. You're going to make electronic copies of it. But in this case, intangible asset. You're not going to say PPE fishing license. Another example, developing a prototype. What is a prototype? You went and did some research and you found out that um, um, you're going to be able to develop a new type of technology, a type of machine, or some sort of model. And that can be used to produce or manufacture in bulk later on. Right? So a prototype is an early sample or a model used to test a concept or a process or act as a thing to be replicated or learned from. Right? So the prototype does have a tangible aspect. It has it's a physical item that is used to test. It also has an intangible form. The prototype is formed as a result of months or even years of research and development and is therefore a byproduct of this knowledge rather than the physical parts that make the prototype up. Right. So for example, let's say you developed a new kind of router that you can take anywhere in South Africa. You can even be in the most remote location, and it will have um, connection to the internet. It's super strong. Right. Now, that modem is made up out of plastic and a bit of metal. That plastic and metal cost about 1,000 rand. Now, are you going to say, okay, I've got this 1,000 Rand PPE? Or are you going to say that this technology, this prototype that I've got in my hand, is actually the technology, this is the intangible form. The prototype, right, will be able to, and nobody else has this technology. I've developed it myself. Right? And someone is out there is going to be willing to purchase this from me for millions of rands. Right? Not because it's the 1,000 Rand plastic, it's because of the technology behind it. Right? Because of the research behind it, of what it can do. He can go and produce this technology that nobody else has and sell it throughout the country. Right? So for a prototype, the intangible asset is also more significant, as the prototype would not exist without the prior research and development. Okay, so you've got to look at which is more significant. If the tangible is more, then it's IAS 16. If the intangible is more significant, IAS 38. And you're allowed to argue. You are an accounting student. You are looking at the theory. You're allowed to have your own opinion, but you must have some sort of discussion or some backing behind what you're claiming. If you can prove that to the auditors, that you believe the intangible is more significant or the tangible is more significant, you can prove it to them and have a discussion with them. You can recognize it however you like. Okay, so that is the three parts of the definition, or the four parts of the definition. An intangible asset, identifiable, non-monetary asset without physical substance. Now that you've proved that it's an intangible asset, can you recognize it in your financial statements? That's where the recognition criteria comes in. What is the recognition criteria for an intangible asset? The expected inflow of future economic benefits must be probable. So you got to basically that this through purchasing this brand, for example, let's say you purchase the McDonald's brand. The expected inflow of future economic benefit has to be probable. So you're going to use that brand to sell quarter pounders and royal deluxes and whatever other burgers you get and French fries and those kind of things. So if you're going to do that, then obviously the inflow of future economic benefits is probable. If you buy this, brand, and you're just a rich man, and you buy the brand, and you're not going to use it, just buy the McDonald's brand and you throw it away in the bin. You don't use it. Then you can't recognize it as an asset because you're not going to use it. It's not going to be probable. The cost is reliably measured. Now, if you've bought this brand or paid for it, but obviously it's reliably measured because you got an invoice that says that you purchased this brand. All right, we've gone on for 40 minutes. Right, we've discussed the definition of an intangible asset and also the recognition criteria. Now, once you have proved, right, so let's say you get a question and the question is, they give you a certain transaction or a few costs that you've incurred, you've bought a brand or something like that, and they tell you, how should this be recognized? So you go and write down your theory. You say that it can only be recognized as an intangible asset if it meets the definition. What's the definition? Identifiable non-monetary asset without physical substance. And it's also got to meet, so you go and prove each one of these items. Right? Then you go and prove the recognition criteria. If you are able to do that, then you can conclude at the end and say, therefore, this brand or whatever, this item, this patent, this copyright, this newspaper mast, whatever, There are some other examples. What are other examples of intangible assets? Brand names, author rights, computer software, license, franchises, copyrights, patents, recipes, formula, model designs, prototypes. Then you can say, therefore, this item meets the definition, this patent or this model meets the definition of an and recognition criteria of an intangible asset and can be recognized as an intangible asset. So you'll debit intangible asset cost and credit bank. And so that's initial theory. We are done with part one. When you debit intangible assets, at what amount are you going to debit it? Right? Remember property, plant, and equipment, we debited it with costs. And what was the cost? It was purchase price plus everything else that is directly attributable. It's the same case here. Right? So remember, we are going now to the second part of the standard, which is initial measurement. When you first purchase this, you get this intangible asset and it's going to be recognized. It's initially measured at cost. What is cost? Purchase price plus directly attributable cost. For example, let's say you bought the McDonald's brand, but you needed to pay lawyers' fees to get this brand of 100,000. You'll add that to the cost. So you'll debit intangible asset, not only R1,000,000 or whatever purchase price, but you add the 100,000 as well. Don't forget to deduct discounts, rebates, refundable taxes like VAT, right? And add things like non-refundable taxes like import duties, customs, and that kind of thing. If you don't pay the import duty, you'll never be able to get that asset. So it's a directly attributable cost. Okay, what are directly attributable costs? The cost necessary to bring the asset to the condition that enables it to be used as intended by management. Right. And also don't forget about when the asset is paid for beyond normal credit terms. Right. The asset is measured at the present value of all future payments, and the difference between the payment made and the present value must be recognized as a finance cost. So we did an example of this during PPE where we said that, let's say, for example, you buy an asset, or let's talk about in terms of an intangible. Let's say you buy an intangible asset and you're going to pay 1 million Rand in a year's time. And in the question, they tell you about a market related interest rate, or they give you an interest rate. Right? What you're going to do is you need to present value that intangible asset to day one, and you debit it with a reduced amount. You won't debit it with the million Rand in a year's time. You'll present value that amount and recognize it at the lower value, or the amount that is the present value. The future value is a million Rand, which you're going to pay in a year's time. Your present value and anything, and the difference between the present value and the future value will be recognized as interest or a finance cost. Okay, we are going to come to an example of that in example 2, right? So I'll show you the calculation of how to do that. Okay, it's 11:15. We are going to take a break here. During your break, if you feel you still have energy to read, you can read over example 1, which is we're going to discuss initial recognition and initial measurement. Okay, 10 minutes or 9 minutes break. We're going to come back at 11:25. All right, guys, 11:25. Let's start off again. Got a few questions here in the chat. Sir, after the break, can you please explain what capable of being separated from equity means? Well, as I said, it doesn't have to mean um, separated from the entity, equity. It can be separated from the entity. Right. So I think that is causing a bit of confusion, but I won't just leave it there. Even so, don't say equity. Let's change this. It's got to be entity. Entity. Yeah. Thank you for picking that up. I need to. Okay, I'm gonna replace the notes on learn so that this change is taken into account. Right. Now, capable of separated. What does that mean? So, for example, let's say you are a business and you have an excellent customer base. Why? Because you've done your business diligently, you've um, developed a good reputation. Let's say the name of your business is Majestic Travel and Tours. Right. So you always, when clients come to you, you welcome them, you um, always find the best travel option for them. You always have the best prices. When they go on the travel, you follow up with them. You make sure that they're all okay in their hotel suites, that they have all activities. And if there's any issues, you always sort the issues out and you make sure they come back happily and safely, right? And you're known for that. So you recognize goodwill, right? So you've got 500,000 Rand worth of goodwill. Now, so you've got that on your financial statements. Can you take that 500,000 and sell it to Royal Travels and say, here's my goodwill, I'm giving it to you? You can't do that. You can't just sell your goodwill because that's your goodwill associated with your Majestic brand. And so you can't separate that goodwill and just give it to someone else. Right? So that's internally generated goodwill. So you can never recognize eternally generated goodwill as um, what you call it. You can never recognize internally generated goodwill as an intangible asset. Right. So that's what it means, capable of being separate. Now, another example would be um, if you were given a fishing license, right, and that fishing license was specially made just for your company. It's got your company name there. Now, and it is illegal for you to transfer this intangible asset to someone else. You can't, like, for example, I've got a fishing license, it's under my name. I can't go and give Joe Smith this fishing license and sell it to him for whatever, 70 bucks. And now he can take my fishing license and go and fish. Right? So it can't be separated from me. That license is under my name. And the government doesn't, Department of Fishery doesn't allow me to go and sell this to someone else. So it can't be separated from me. But it doesn't mean that it's not going to be an intangible asset because it can arise from contractual rights or legal rights. Now, that was the second question the student asked. They said, and also contractual rights. I was a little bit lost there. So, what's a contractual right? You signed up with McDonald's and they told you right, whatever your name is, Mr. Joe Smith, you are allowed to use the McDonald's brand and, for example, print it on your t-shirts or make a restaurant with McDonald's brand name and sell McDonald's burgers. That's a contractual right? Because you drew up a contract and that contract allowed you a trademark. That's the explanation of a contractual right. Okay, so let's pick up where we stopped. We stopped when we were talking about initial measurement, purchase price, and directly attributable costs. Right, so let's have a look at this example. A record company acquires the copyright of a musician, which allows the company to record the artist for a period of 5 years. During the first 6 months of the contract, the musician was very ill and could not record anything. The following costs were incurred regarding the copyright. Remember, we're talking about day one initial measurement. Right. Legal fees of 200,000 Rand to help with the acquisition of the copyright. Right. And 1,710,000 to purchase the copyright. So this is your purchase price. It includes that. So obviously these two amounts are your purchase price and directly attributable costs. Because if you didn't pay this legal fees, you wouldn't be able to get your, so it was to help with the acquisition of the copyright. So these two amounts, right, the 1.7, you're going to take out the VAT, right, your purchase price, times by 100 divided by 115. Right, that's 1,486,956. Right, the reason they have 1.5 here is they're using the old VAT rate, right, of 14%. It can't be this rate. So let's change up the amounts here. Let's say it was purchased for 1,725. In your tests and exams, make sure you don't use 14. You may still see 14 somewhere around there. Right. So please make sure you you don't use 14%. That's the old VAT rate. Make sure you use your 15%. All right, and the legal fees of your 200,000, let's say this is X VAT. Right. So these two amounts definitely are going to be added to the cost of the intangible assets. So your 1,725, take out the VAT, you times by 100, divided by 105, you get 1,500. Okay, then it's not 1,710 anymore. 1,725. Okay, don't worry, I'm going to put this up for you with the corrected amounts. Right. 225. Okay, I think this is now right. Okay, this I've updated it to use the 15%. Make sure in your work, whenever you see 14%, go and change everything to 15%. We can't use the old VAT rate. Okay, so we've accounted for the legal fees and the copyright. During the 6 months when the musician was ill, the studio paid studio fees that amounted to 40,000 Rand. Right. So this is just expenses after you already purchased this copyright. And so that doesn't have to do with the directly attributable cost to the copyright. This has to do with cost for studio fees. Okay. Studio fees were not incurred to order or acquire the copyright, but rather because the copyright was acquired, the musician was ill and could not be recorded. Right. So this studio fees has nothing to do with acquiring the copyright. So that we're just going to expense. We don't add it to the, the initial cost. In the 6 months, there was no recording took place. In which there was no recording took place, the company suffered a loss of 450. Same thing. The operating loss is a cost that was incurred after the acquisition of the copyright, and therefore cannot be classified as a directly attributable cost. After the 6 months, the first single was recorded, and an aggressive marketing campaign was launched to boost sales. 620,000. Again, the marketing campaign was done after the acquisition of the company. It cannot be classified as a directly attributable cost. The marketing campaign can also not be classified as a separable intangible asset or a separate tangible asset as the definition is not met. Therefore, the total cost to be capitalized is the 1.7, which is your 1.5 purchase price plus 200,000 legal fees. So you will debit intangible asset cost or cost intangible asset 1.7, credit bank or payables 1.7. Right. And don't forget about your VAT. Let's do the journal entry with the VAT so you can see clearly. That's on this case, we're going to say, here's our journal entry. We're going to say debit intangible asset cost. You can even call this intangible asset copyright. Copyright. How much? It's going to be your 1.7. Right? And then you've got bank / payables. What did we actually pay? We paid 200,000 legal fees, ex VAT. So the 200,000 with VAT is going to be 230,000. So you're going to say plus, and our purchase price with VAT was 1.725. Right, so that's our bank, and the difference is going to be VAT input. That's the receivable. You will get your refund from SARS of 255. Okay, but the main, what I want you to see is this. You're going to debit it with the 1.7 intangible asset. Okay, example 2. A company purchases a patent on the 1st of Jan 2015 The company has organized with the lawyer concerned a payment of 1.1 million, which will be made on the 31st of December 2015. So in a year's time, the payment will be made. This is not considered to be normal credit terms. Key tells you we need to do some present valuing. The effective interest rate is 10%. Again, another key. When they tell you this information, you must know I need to present value this amount. At what value will the intangible asset be valued on the 1st of Jan 2015? Right. So you can go and look at your present value formula, or you can just divide by 1 comma 1, 1 comma the interest rate. So I take my 1 million, divide by, not times, divided by 1 point. And what's my interest rate? If my interest rate was 12, I'll say 1 comma 12. If it was 8%, I'll say 1,08. If it was 6%, I'll say 1,06. If it was 20%, I'll say 1,20. But it's 10%. So I'm going to say 1,10. So I'm going to record the asset or debit property intangible asset here with 1 million. That's my journal entry. Even though in a year's time, what am I going to pay for it? I'm going to pay for it 1.1. Okay. So even though I'm going to pay 1.1 for it in a year's time, I'm going to record this asset at 1 million at its present value. As time goes by, 1 year goes by, I'm going to say debit finance costs or interest expense with the 100,000 and credit the payable. And obviously, if I'm paying in a year's time, I can't say stroke bank here with 100,000. Right, so this will be done at the beginning of the year. So the 1st of Jan 2015, and this journal entry will be done at the end of the year, 31st of December 2015. Can you see no matter what my asset stays at the present value? And when I finally pay, can you see what's my payable amount? It's 1.1, which is what I am going to pay at the end of the year, which is 1.1. That will be bank. Present value, they love to ask this question. Present valuing. Okay, before I move on to some questions, the last part of this example, would your answer change if this was considered normal credit terms? Meaning, like, you know how you normally go to the shop and you tell, and they have something called, you can pay within 30 days or you can pay within 60 days, and that's normal. Then you won't present value it, right? So you would, yes, the answer would change. You will just debit intangible assets 1.1 and you're payable at 1.1. Then you won't have this finance cost. If it was normal credit terms, but they told us that it was not considered normal credit terms. Okay, let's take a few questions. How did we get the VAT input figure? Okay. Well, I just took the amounts that we paid. Right? The amount that we paid for the purchase price was 1725, right? And the lawyer's cost, excluding VAT, was 200,000. So 200,000, if that's X VAT, that will, to get the amount with VAT, you're going to times that by 115 and divide it by 100. So the amount with VAT is 230. Right? So the amount we paid was the 230 plus 1725. So to get the VAT figure, it's just the balancing figure, 255. Or you could go and you could do it separately. You could say, okay, if my lawyer's fees was 230,000 with VAT, well, let's just say without VAT, it was 200,000. Right? So we got lawyer's fees 200,000 without VAT. So we say 200,000. We want the VAT amount, so we times by 15 divided by what we have, which is the 100 amount, 30,000. So 30,000 is the VAT on the lawyer's fee. Then what's the VAT on the purchase price? It's 1725 times by what we want, which is a 15, divided by what we have, which is the amount with VAT, the 225. 225 plus 30,000 for the VAT lawyer's fees is 255. Right, so there's two ways of getting the VAT. One is a balancing figure, the other way is to actually go and calculate this. I can't spend too much time with this. You learned how to do VAT calculation last year, right? And also we did it a bit in PPE. Make sure you know how to calculate the VAT portion. Okay, subsequent expenditure doesn't normally arise. Now we're talking, remember we said the different parts of a standard, first part theory, second part initial measurement. We're now going on to, after time goes by, subsequent measurement and subsequent expenditure. It doesn't normally arise. Like let's say you get a brand name or a patent or a copyright, it doesn't normally arise. However, if it does meet the same criteria we applied on initial recognition, it must be applied and only then can the costs be capitalized. So if you get a question where there's subsequent expenditure, right, and what you'll do is the exact same process for initial recognition, where you take the definition and the recognition criteria and apply it, and it does meet the definition of intangible assets, then you can add it to the original intangible asset, but it doesn't usually occur. And just one thing about the definition again and recognition criteria. Now in IAS 38, they specify the old recognition criteria, which is these two. Right? In the new conceptual framework, they talk about faithful representation and relevance. Right? So that's the new recognition criteria. But remember, the standard always takes precedence over the conceptual framework. So the standard still has the old criteria. So you must use the old criteria in your discussions of intangible assets. Don't use a new concept unless they tell you talk about the new conceptual framework. Then, but if they talk about as per IAS 38 intangible assets, then you'll use the old recognition criteria. Okay, what about subsequent measurement? But after time goes by, like how we had PPE, we had to talk about things like, as time goes by, we talk about things like depreciation and impairments and revaluation and that kind of thing. Okay, for intangible assets, it's much simpler, especially for first year. Right, first year, we're not going to talk about impairments. It's not examinable. Right. And intangible assets, as per IAS 38, can be done on the cost and revaluation model. You can measure it according to those two models. But for accounts 102 purposes, we're only going to be looking at the cost model, not the revaluation model. Okay, so what does this mean? We basically only have to talk about depreciation or the equivalent. And what is the equivalent for depreciation for intangible assets? It's called amortization. Right? It's a different term, amortization. So don't debit depreciation. You're now going to debit amortize. Don't talk about depreciating intangible assets. It's wrong. It's basically the same thing, but it's called amortization. And there are a few differences which we are going to be looking at. Right, the first difference, or the first part of amortization, when do we begin amortizing? Is when the asset is available for use, right? When it's ready to be used. Now, the intangible asset, when it's ready for use, it can have a finite or an indefinite useful life. Right? If it has a finite, what does finite mean? Like our lives as humans are finite. What does finite mean? Limited in size or extent. So if we're saying that the intangible has a limited useful life, meaning like, for example, let's say we bought the right to fish a certain area for 3 years, right? So that is your useful life or your fine. So it has a finite useful life. The other kind of life is an indefinite useful life. Notice we're not saying infinite because nothing is infinite. So you say indefinite. An indefinite useful life means that there is no foreseeable limit to the period over which the asset is expected to generate net cash flows for the entity. Right? So we can't see what is the end. If you can't see what is the end for this brand or this asset or this intangible asset, it's got an indefinite useful life, not infinite. Remember, maybe the religious people will say, okay, only God has an infinite life, right? But a, like a brand has to end. One day there'll be no such thing as Coca-Cola, right? Maybe 1,000 years or 100,000 years or whatever, but nobody's going to be drinking Coke. They won't even know what is Coca-Cola, right? Even though it's indefinite. We don't know when it's going to end. Right? So this is the two different things. You've got a finite life or an indefinite useful life. Right? So for a definite, or actually this should, yeah, for a finite useful life, that shouldn't say definite, it should say finite. Okay, so for a finite useful life, you're going to pass amortization and it will be expense, just like depreciation. Right? In which case it can then be capitalized, or unless it's for the creation of another asset. Okay, so if you're using this, okay, but I think for first year purposes, don't worry about this. But basically, if you're using one asset to create another asset, then that amortization or depreciation actually can be added part of it, the initial cost of the new asset. Right? I don't want to confuse you too much now. I want to just look at amortization. Right? So if it's got a, they tell you this, we've entered into a contract and we've got a fishing license for 3 years, you're going to amortize over 3 years. If they say it's got an indefinite useful life, we don't know how long this asset is going to provide value to us, then there'll be no amortization. Nothing. That's the easy one. Okay. 3 variables for amortization. The first is your residual value. Usually it's always zero. Intangible assets, residual value is usually always zero, unless these criteria are met. Either a third party has committed to purchasing the asset at the end of its useful life. So somebody has said, hey, this intangible asset that you have, after you're done using with it, we want to buy it for X amount. Or there's an active market for this intangible asset. And it's possible to measure a value, for example, 100,000, and it's probable that the market will still be there at the end of the useful life. So it's no good in the market will be here now, but at the end of the useful life, the market won't exist anymore. Right? So for a residual value for an intangible asset, it has to meet these two criteria. Okay, let's look at an example. An intangible asset is purchased for 100,000 Rand with a useful life of 5 years. So is this finite or indefinite? It's finite. It tells us 5 years. Therefore, we have to consider amortization. If it was indefinite, no amortization. It'll become like land. You just leave it alone. The business is hoping to sell it for 30 grand after the 5 years has ended. Determine what the residual value would be if, right? So we got some scenarios here. No third party has committed to purchasing the asset and there is no active market. So does it meet any of these two criteria? No third party, no active market. So our residual value is still going to be zero. So zero, because the requirements have not been met. Second scenario, no third party has committed to purchasing the assets. There is an active market at present, but no probability that it will exist in 5 years' time. So there's no third party. The active market, yes, there is an active market, but it's not probable. So this is not met. So this point is not met, and the totality of this point is not met. So it's still going to be zero. Third option, no third party has committed to purchasing the asset, and there is an active market but there is an active market at present, and its probability, and it is probable probable that it will exist in 5 years' time. Okay, so no third party, so this is not met. Nobody has told us they're going to purchase it, but there is an active market. It's possible to measure the residual value using that market, and it will exist in 5 years. So it's going to exist at the end of its useful life. So in this case, we will use the residual value of 30,000. Even though no one has committed to purchasing, there is an active market, and it is anticipated to exist at the end of the asset's useful life. Okay, last option. A third party has committed to purchasing the asset, but at 10,000 Rand. In that case, we're going to value it at 10,000 Rand because of the third party. Even though the business would like to sell it for 30,000, the commitment is only for 10,000. Right, and the last thing that we're going to be discussing today is the period. What period do we amortize over? We need to amortize over the shorter of the asset's expected economic useful life and its legal life. Right. So if this brand has a long economic useful life, it can be used for 100 years, but the contract or the legal life, what it says in the contract says we only allowed to use it for 10 years. Then we're going to use the 10 years as the useful life, even though it will be economically viable for 100 years. So the shorter off. If an asset has a limited legal life, the economic useful life will be limited to the legal life if shorter, unless legal rights are renewable. And there is evidence suggesting that the entity will renew these rights, and the cost of renewing will not be significant. Okay, there's a lot of words there, but basically, let's look at this example, right? A fishing company purchased a 3-year corporate fishing license for 150,000. What will the useful life be if, let's look at scenario 1. The license can be renewed for 2 years at an insignificant cost, but the company is not planning to do so. Will it be 3 years or will it be 5 years, renewed for 2 years? Let's look at the criteria. If the asset has a limited legal life, the economic useful life will be limited to the legal life if shorter, unless they are renewable. Here it is renewable, and there is evidence suggesting the entity will renew these rights. But the evidence is the company is not planning to do so. Therefore, we will keep the 3 years. We're not going to make it 5 years because they are not planning to renew. Scenario 2, the license can be renewed for 2 years at 1,500, and the company will be renewing the license. Okay, so we got a 3-year finite year legal life. It is renewable for 2 years, so meaning you can renew it for an extra 2 years to make it 5 years at 1.5. Look at 1,500 compared to what we bought it for, 150,000. It's just 1%. So it's insignificant. And the company will be renewing the license. So the evidence is suggesting that we will renew the license. Therefore, we will amortize not over 3 years, but over 2 years, over 5 years. The 3 years original plus the 2 years which we're going to renew after the 3 years are completed. So your period is now going to be 5 years because the criteria were met for renewability. Okay, the last scenario that we are going to be discussing today, the license can be renewed for 2 years at 140,000, and the company will be renewing the license. So yes, the rights are renewable. There is evidence suggesting the industry is going to renew, but the costs, are they significant? Look at this cost, 140,000. It's almost the cost of the original intangible assets. It's almost the cost. Therefore, it's a significant cost. It's not insignificant. So we will not use 5 years as our period, but we will keep it to the 3 years. Because even though the company intends to renew, the renewal cost is significant. Almost same as the original. It has to be insignificant. The cost must be like insignificant for us to increase the period to 5 years. Okay, and you can use different methods to depreciate, to amortize, straight line, diminishing units of production. And remember what I said, if it's an indefinite useful life, you will not amortize. You'll just leave it at its cost. Okay, tomorrow we're going to be discussing exchange of assets and internally not tomorrow, sorry, Wednesday, we're going to be discussing these two. Thank you very much, everybody. Remember, intangible assets concept test is now open. And also, you can even go and complete concept test 3, property, plant, and equipment. Because it closed a bit earlier, we have extended it. So make sure you do go and do that. And also, you can go and do the intangible concept test. But I will be staying around for a few minutes for questions. But if you are happy to leave, thank you very much, everybody. I will see you on Wednesday. Okay, I'm getting a lot of questions about scope of test 1. You will be informed of that. Excellent question. Thank you for bringing that up. What do you credit when you debit the amortization account? You will credit accumulated amortization. Debit amortization, credit accumulated amortization. Excellent question. Thank you for picking that up. Look at this, accumulated amortization. Just like how you debited depreciation and accumulated depreciation, for amortization for intangible assets, you will debit amortization and credit accumulated amortization. Any other questions? So how do you gauge the insignificance? How do you know which amount is close to being insignificant or significant? That's a good question. I suppose we have to have some sort of actual absolute value. Look, I would say a rule of thumb is 50%. But you could say 50, if it's more than 50% of the original amount, yeah, it's definitely significant. Right? But that could also be, um, it could also, um, what you call, um, it could, even if it's 40%, that could still be a significant amount. So firstly, you always use it um, in relation to your original cost. So if your original cost was 100 million to purchase that intangible asset, right, and the cost to renew is 40%, then 40 million, how can we say 40 million is not significant? Right? So to find an exact percentage is difficult. So that's where they come in. They say that we've got to look at something called professional judgment and um, look at the company specifically, right? Or in the company on its own merit and its own what you call its own set of factors and its own situation. If it's insignificant to that company, but then maybe we will say that this, like for example, 10,000 Rand to me and you might be significant, but to Pick and Pay, that thing is not even it's a joke to them. Right? They might earn 10,000 Rand a second. Okay, so it is, you will have to use your professional judgment um, in that and argue, is this significant or not? But um, in terms of significance, in your question, you'll be able to tell. But I don't think they will give you one where you confuse. Like they'll tell you that it's like in our example here, you can definitely say that 1%. I mean, come on, 1%. They bought it for 150, and it's just 1%, and then 140 compared. So it's quite clear. It's hard to give a specific rule, but don't worry, for your tests or exams, it will be quite clear. But it's a good question going forward as a CA to um, to determine exactly what criteria we're going to use for significance. Any other questions? Thank you very much, everybody. I will see you on Wednesday to complete intangible assets.